Investors and traders, welcome to the channel Market Shop. And today is 15th of September 2024. I hope everyone is having a great weekend. We will be taking a look at the key US markets in this segment. As always, this video is for educational purposes only. It's not a financial advice. We are looking at our timing model. The timing model has done a really good job of picking key turns many times. And the most recent one came about. We had a timing coming on 10th of September and 11th of September was a pretty good low in the marketplace. I've got another key timing coming in, but this one is on the Japanese index, which one is on the 19th of September 2024, so a day after the FOMC meeting when the Fed is likely to announce their rate cuts. So really interesting with respect to timing, so pay attention to this one. We'll see what the market is, what the price action will be like on next Wednesday and Thursday. So let's have a recap of what the price action looked like last week in terms of really key economic data coming out. So last Monday and Tuesday they were pretty quiet because on the economic front. And then we had the CPI figures come out last Wednesday, and the CPI print month on month was a little bit hotter on the hot side because it was a little bit of a tick up to 0.3% with respect to 0.2%, and the year on year was actually 2.5%. But then on the following day, Thursday, we had the PPI figures come in, and they were a little bit more in line with the expectations. So that kind of cooled the market's expectations that we might actually be the wholesale prices might actually be moving lower, which should help with the inflation figures. But on Wednesday, we had a fair amount of volatility into the market, and then we saw the market actually rebounding, especially with the PPI figures. So with that respect, let's actually have a kind of a breakdown of what is actually in the inflation figures which is contributing to this kind of inflation, because clearly what we have seen is with these figures that actually the inflation is on a downtrend. And we have also seen recently in the past 3 weeks the crude oil prices actually really move lower a lot, and that should actually also tame some inflation figures. Now this is a chart which I got from the Double Line, which is a fund in Los Angeles, California, and they've done a pretty good chart with this really nice looking picture. And what we can see is that in the recent print that we got as of July 2024, we have the biggest component coming in from the core services. So this blue line, this blue shaded region is the core services here, and this is where the inflation lies. It's no longer the core goods here, which was making up a pretty big part of it back in 2021, and energy as well. And crude oil prices, they have been just going down for the past 3 weeks. And this is where we have a big component or big chunk of inflation coming in, which is from the services sector. So that's an important one to know. And then with the expectation of the FOMC next week, it is widely anticipated that the Federal Reserve is likely to reduce the interest rates. Now the question is whether it's going to be by a quarter point or a half a percentage or 500 or half a percentage point. So here we have a chart which is basically Fed fund rates, which is this line in this red color, maroon color, and we have the yield plotted in the candle chart 2 year. And we can see this is a pretty long dated chart going back to the 1980s as a monthly chart. And really interesting is, you see these figures here. This is going back to the period of 2006 and 7, which is a great financial crisis when it started. The Fed fund rates, they stayed for quite some time around this region, and this is when the Fed started to cut rate, but also it was the start of the crisis as well. But before the cuts began to happen, what happened was the yield on the 2-year note, it actually began to drop. So it looks like the Fed kind of watches the 2-year Treasury note, and whatever it foretells, Fed actually reacts to it accordingly. And then back in the 2000 era, it's something similar as well. Now, the interesting part to note is that back in 2000, the Fed fund rates, because before the Fed started to cut, in terms of time, did not stay flat or near that top rate for that much time. It was quite a bit in terms of when the Fed was quite put around this region here in 2006 and 7, and then we have a fair amount of time where the actual Fed has kept the monetary policy pretty tight. But also the interesting aspect to note is look where the 2-year Treasury note is now in terms of its yield. So its yield has actually fallen quite a lot, which is an indication that perhaps the Fed might be a little bit more aggressive in terms of cutting their rates. And if you just look at this, just a pure look, it looks quite similar to what was happening around here, 2007, and here looks similar, but of course the fundamentals are a little bit different. And now I think the key thing is going to be if the rates remain that high and inflation, which is going down now, but what it has led to is the disposable income for consumers putting a strain on their disposable income. And then of course the house prices in the US in particular are fairly elevated. So in some sense there could be some resemblance to this one, but I believe that the fundamentals are pretty different right now, and the Fed has quite a lot of leeway in terms of their interest rates to stimulate the economy. So we'll have to wait and see. Now, something similar is also visible on the 10-year chart as well. So this is the chart of 10-year Treasury note, which is in the candlestick, and then the maroon line is the Fed fund rates. And here a little bit of a distinction is that in the previous cycles, for example, if we look at 2006 and 7, the 10-year yield remained pretty elevated, and then in comparison to 2-year in particular, and then it just began to move lower when the interest rates or the Fed began to cut rates. This time it is already much lower, not as low as the 2-year, which is kind of expected because of the shorter duration. 2-year is somewhere around here, but the 10-year is a little bit higher. But you can see that compared to the previous cycles, it has moved quite a lot to the downside, and this just top came from the 1.618 expansion of this swing as well. Now, if we just take a look at the CPI or the Fed fund rates versus the CPI, there's a really nice graph which the double line had in their presentation. So I took it from them, full credit to them. And what it shows on this is basically it's the US Fed funds effective rates minus or less the US CPI year on year. And you can see the green bars is when the Fed fund rate is higher than the CPI, which is the consumer price inflation. And so basically Fed fund rates have been elevated in comparison to the Fed fund to this inflation for quite some time now. So this is a green one right here, and this was a small region that we had seen all during this 2009 to 2019, that 10-year period. Of course the rates, Fed fund rates were really low, and this is the period where they began the massive amount of quantitative easing, because in response to the pandemic and the inflation, you can see that the Fed fund rates were way lower, and then the situation began to change right here. So it's really interesting to see. So this is the reason, another supporting data point, that Fed is likely to cut rates, and they could be a little bit more aggressive towards it. We have talked before about the yield curve, that it steepens before a pending recession. So one of the things is what we did was we had actually taken the 2-year treasury note, and then we basically subtracted let me actually do it on a weekly chart. It's going to be a little bit easier to see, and then we just subtract the 10-year from the 2-year treasury note. So we take this and here, and we just and then we do minus T and X. Okay, so I think it's gonna be like this. 0, 2. Oops, what am I doing wrong? Let me start again. Okay, I'll remove this one, and let's take on the same. Okay, well, I don't know why, but I'm not able to do it right now for some reason. So okay, let me actually show you what I really wanted to show you. So it's also another chart from a double line, the fund in Los Angeles, and they have done a really nice a chart like this. Maybe I'll start to do charts like this as well using perhaps Python. And what I really wanted to show was if you take the 2 years and 10 years spread, and then you can see that it has turned positive recently. So this data is going back as of 9th of September, and we see this kind of situation happen just before a recession. So look, this is going back to 2007-8 period. This is the 2000s, and before the 1990s. So this is another signal that perhaps we are very close to a recession, if the economy might not already be in a recession. And we also discussed a few weeks ago, about a month ago, the sham rule, where it's a really simple rule, and that also indicates that perhaps a recession is very close. So the recession fears, they are there, but it's also possible that the stock market actually remains pretty stable, because of course with the yields coming lower, it is actually stimulative for the asset prices. So it's going to be really interesting how the market's price action will unfold this coming Wednesday and Thursday. So let's take a deeper dive into our stock indices. So let's take a look at the S&P 500 first, and I'm going to move over to the weekly chart. Here we go. What we can see is that the market was really strong last week, and it has pretty much recovered all that damage that was done on the week of 3rd of September. So it looks like we are actually probably will be able to make another new time high in the S&P 500, a new all-time high. We do have higher targets where we complete the ABCD, so that remains on the charts. And if we take a look at the NQ, which is the NASDAQ 100 futures chart, we can see that it also did a pretty nice recovery, but the price action is still contained by within the negative candle of 3rd of September. There is a bit of a trend line here, but the chances are the market might actually be able to overcome that. And on the NDX, we have this gap formation. This is the cash chart for S&P for the NASDAQ 100, and here we go. So this is what we looked at. I think this is where the market wants to go and close this gap, maybe in full or maybe to the half. We'll have to wait and see, but you can see pretty strong since last Wednesday, pretty strong price action in the indices. The S&P 500 futures, similar pattern to the cash. We do have higher targets for this one, and looks like the market is strong. If it's able to get above the highs of 3rd of September, then above 6,170 roughly, a little bit lower, anywhere within the vicinity of 6,100 to 6,170 is the kind of region we can take a look at. Of course, the situation will change if the 5th of August lows get taken to the downside, but I don't think that is likely to be the case. The worst case scenario is probably a range bound market, testing the lows of 5th of August, but I think the direction is to the upside for S&P 500 in particular. Now if we take a look at the Russell 2000, here we go. Also a positive candle close, but it needs to do a fair amount of work for it to improve from a technical perspective. Really needs to get above the 2318 or roughly 2320 level, and that might indicate we might be in ABCD higher, but this market has gone in a sideways trading range. So it's really important. I think the lower interest rate environment should be beneficial to the Russell 2000. Whether that Russell will be able to lead the overall markets, I'm not sure of that, but we could see some improvement, maybe a retest of the upper bound of the trading range. We'll have to wait and see. And then if we take a look at the Dow Jones, I want to show you something on the cash index for Dow Jones. Now here we go. You can see there is some timing around here. 18th of November is also a key date, which is coming up on the weekly charts, but that's another topic. So there's a possibility that this index might be actually in this ABCD higher, but it's very close to its 1.618 expansion, which is some of the other indices like S&P 500 and NASDAQ already done their expansion of this 2022 bear market. So it's very close to that. It's likely to actually make new all-time highs and actually reach that level. This is a kind of expectation. Whether it will actually be able to complete this big ABCD, we will have to wait and see. If it is able to do that, then it'll be the third index completing this big ABCD. S&P 500 and NASDAQ have already, S&P 500 has not done that, but NASDAQ has actually already done that. Now let's take a look at the NYA, which is the New York Stock Exchange Composite Index. It's very similar to what the Dow Jones is doing, and this index is some ADRs as well. I believe it has about 1,600 to 2,000 stocks, including the foreign stocks, such as Alibaba, which are ADRs essentially, American Depository Receipts. And here we go. So we have possibly in target 19,980, so roughly 20,000 for this index. The momentum remains strong for this one. So really interesting, the kind of picture which is unfolding. Let's take a quick look on the foreign markets as well. So we'll start by taking a look at the FTSE 100. Here we go. So FTSE 100 has been range bound for quite some time now. And one of the things is that it did this ABCD pattern right at the 38.2% retracement, structural support here. And then ever since that, it's just range bound. There's not much happening in this index. And I think on the daily chart, I had a little bit higher target for this index, that it could perhaps reach 8,560. So it remains to be seen. You can see that it's just in a trading range, whereas the US indices seems to be stronger now. And then if we take a look at the German DAX, formed a perfect 38.2% retracement of the lows of October 2023. On the 5th of August, and this is one of the things that I talk about on the channel, that the tops, when they are formed, the tops could form in different markets at different times, but usually when a proper bottom is formed in all indices, it forms in unison. So 5th of August is an example. We have seen all the major stock indices bottom on the 5th of August. We saw this come in FTSE 100. Japanese Nikkei, and also in the German DAX. This is how, at least in the stock market, the bottoms are formed. In other less liquid markets, it might be a little bit different. So here, just like FTSE 100 retraced to 38.2% retracement, this one looks stronger. In particularly with the price action of last Friday. So I think it's gonna go and complete that 1.618 expansion that we had been watching for, and we could even have higher targets now because we have a bigger range to look at, and that range is from here to here. And let me get the 1.272 out. Here we go. So for 19,416, that's a possibility, and this market might actually be kind of traveling towards that figure. So we'll have to wait and see. If it closes below the 38.2% retracement, a lot of things change, because that means that it was just a test of the upper boundary of the range and failed. So it's a double top formation. As long as this 30.2% retracement is held, there's a chance the market could actually reach this 1.272 expansion and 1.618 expansion. And now let's take a look at some of the sectors. So let's take a look at XLRE, which is the real estate sector, and here we can see that. Let me actually move over to the weekly chart. It looks pretty strong. Here we go, and there we go. So really interesting. We were watching for a possible target for the 61.8% retracement, and I had drawn this pattern the last time we took a look at, and then it might prove to be a strong resistance level. But look at last Friday's close. It's really strong. Now, ideally, I would like to see two consecutive closes above this level, because we have seen this kind of a close before, a really positive close, and there was just no follow through. So this is really important that we get a proper follow through. So I would really like to see another weeks of price action. But it's good because at least it means that it was able to take the 61.8% retracement. Now it's going and challenging this swing high right here. Okay, now let's take a look at the XLU, because the utilities, they were performing pretty good, and there we go. So I believe utilities are actually now making new all-time highs. So this is really interesting. So this one has been a strong tier higher, and with this here we go, taking out these highs out, I would like to see another close higher, but this one already has been in an uptrend. So normally what happens is that whenever there is a breakout of a range, so if you look at all of this 2023 to 2024, 2022 to 2023 bottom, this is all it's a bear market, but it's also trading range. So if we just look at this expansion, here we go. This market has a little bit higher to go, 84.50 roughly will be the 1.272 expansion. So we'll have to wait and see. And then if we take a look at the XLP, which is the staples, consumer staples, this one is also strong. So there you go. So this is the the thing that we were talking about in terms of rotation in the market. Utility is strong, staples making a new all-time high. And if we now, let's take a look at the XLV, which is the healthcare. Has been fantastic as well, but looks like it's just going in a trading range now. I don't like the candle formation of 3rd of September, so looks like it's getting ready for some sort of a pullback, maybe to the 20-week moving average. So healthcare sector is interesting. I think it's getting ready for some sort of a pullback, whereas utility staples moving higher. And then if we take a look at XLK, which is a technology, here we go. So what a comeback in the technology last week. But if you compare this with utilities or the staples, then you know where they are, and you can see that this is the rotational aspect which is happening in this market. Now let's take a look at the XLY, because something really interesting happened with the consumer discretionary. And discretionary had been under a fair amount of pressure, and we have seen that like the tech stock, it was getting a beating, and then now last week was a pretty good week for the discretionary. So it's really interesting to watch. So I think this 196 200 is going to be some resistance level. Once it's able to get above that and above this channel upper boundary, it's going to be pretty good for this sector. While we are at it, let's take a look at Amazon, which is part of it. And here we go. So Amazon also had a pretty good week last week, and this pattern that we were watching, it's been negated. The 78.6% is a little bit higher, so I think really good price action for the Amazon stocks is really interesting to see. Now something really interesting, which is the industrial. We spoke about it a couple of weeks ago, that the industrials were actually getting stronger, and they have been. We had a pullback right to the 20-week moving average. I think it's got a chance to go and hit 141, 142 level. So industrial, that's another aspect of the rotation going on. So keep on watching the industrials. They look pretty good. Now, if we take a look at XLB, which is the materials. So this one has been doing okay, but it's just in our trading range for quite some time. In fact, pretty much 2024 has been a range bound year for the materials. So yeah, I mean, looks like here maybe we might be able to get above to 98. That's the 1.6 minute expansion, but looks like more of a trading range behavior here. And then the XLC, which is the communication services. So it's been a really nice looking trend, and we just draw a trend line here. But when it had pullbacks, the pullbacks were pretty big. So you look at this is like a little bit lower than the 78.6% retracement of the lows of March 2020. So let me draw it. Get the 78.6% retracement. So there you go. So retrace 78.6% retracement. This reminds me of the Meta stock. Then it has made new all-time highs, but it could also be if it breaks this trend line, it could also be a double topping pattern. With this kind of a strength in the trend, I think the chances are it is likely to move higher actually, but we'll just keep on watching this trend line really closely. Now let's take a look at XLE. Okay, XLE broke this trend line, or not very convincingly, but it's very close to doing that. So what it means is basically there is a fair amount of weakness coming in the energy sector. And if you look at the price of the crude and what it has done over the course of the last 3 weeks, crude has been much weaker. So with the crude remaining in the 60s, high 60s, if it begins to move towards low 60s, I think these stocks are actually not going to be performing that well. So if we were to look at the price action of, let's say, ZOM, the ExxonMobil, you can see that it's been in a pretty long trading range. It has these nice rallies. I think they might have to do something with OPEC coming out with their expectation they'll cut production, but then they actually do the reverse, and maybe some geopolitical uncertainty. But you can see that it is just going nowhere. It's been in a trading range. In fact, you can go back and see this from early 2023. So there you go. It's a trading range behavior. And if we were to look at Shell, let me take a look at this on the London Stock Exchange, and we can see that the Shell is really, it's just the support is getting teared apart. It's just tagging the 89 moving average, but looks like it wants to go all the way down to 200. So yeah, you can clearly see that this one broke below this range right here, and it has done a pretty much of a measured move. So you take this and you basically project it here. So it's really holding at the moment, trying to hold, but looks like there's a fair amount of pressure to the downside coming for this one. And look, it has actually gone and made new all-time highs, so that was interesting. I don't think it has made any highs before. Yeah, so I think these were new all-time highs for Shell. Now, if we go and take a look at some kind of subsectors through the eyes of ETF, and we take IHI, which is the medical devices. This is the ETF for it, so kind of related to what we saw with the healthcare sector. This one has formed, possibly, in my opinion, I think it has formed the inverse head and shoulder pattern. I would like to see further confirmation, another week of higher close. Then I think it's got a stab at the highs around here, but it's just been in a long trading range, and now I think it's at a point where it could actually break out of it, and then we could easily have a measured move which takes us back towards these highs. So this one is an interesting one, and something which is really interesting has actually been the home builders. So we look at it through the eyes of the ETF. Look, the home builders, as soon as the expectations began to build with the possibility of the Fed cutting the interest rates, the home builders they have actually been pretty strong. You can see by putting in a bottom in 23rd of October when the broader market did that as well, and did a nice ABCD correction in July, and then it's just been right to the upside. Now the thing is, it completed this ABCD. This big one here, I had a bit of a correction here. Now it's right at the 1.618 expansion of this range here. So I would actually like to see it close above 121. A couple of weeks at least, and that way it'll be an indication for me that actually this CD leg is getting extended, so it could extend by at the most 1.618 times the AB leg, so we'll have a lot further to go. So this one looks pretty interesting. And then if we take a look at XRT, which is the retail ETF, so the retail has been struggling. Now with the retail, it's it's very interesting because we have certain stocks which are doing really well. For example, let me actually show you the ones which are doing really well. Is one of them is Walmart. So here we go. So this is the retail ETF. It's just retraced about 50%. It looks pretty weak to me. So clearly, consumer confidence, it needs to improve. It's not there yet. And if we just take a look at the stock of Walmart, look at Walmart, it has new all-time highs just going through the roof. And I think that's also because of not just because of their dominance, but it's because of they have a component which is in the online sales, is really competing with the likes of Amazon, whereas Amazon stock is kind of struggling. This one is making new time highs, so this just tells you where you need to put your money if you were to compare those two companies. Now, I'm not saying that Amazon cannot make a comeback, because Amazon is also a tech company with their AWS, but the retail arm might be actually not in comparison to what Walmart is with its reach through the retail store. So really interesting one. And if we on the other hand see a company like Dollar General, here we go. Look, such an ugly looking chart. It's just gone back to 80 from 260. So what is going on over there? So it looks like what might be happening is that people who like to shop at Dollar General, for example, they might be the ones which might be getting hit hard with the inflation and disposable income. and they might not be shopping at these stores as much they would have in the previous years. And then there could be other issues with the company itself, such as overstocking of the inventory, some other issues. But you can clearly see that when you look at retail, there are different aspects to it. So one has to be really careful and do own due diligence before looking at what company to invest in. And this one is the software sector. The software sector, usually is the one which has pretty good margins, but it's also right here where it is possibly, putting in a topping formation, which is essentially a trading range at this stage, but it might just remain in this one for quite some time. And then may be able to make enough energy to do a breakout. If it is able to do a breakout, that will be nice, because that's the something which is telling you that is strength behind the stock. It's making new 52 weeks highs, for example, and then also coming out of a basing kind of a pattern formation. So there we go. And then let's take a look at KRE and XLF. We had a look at these financials yesterday, so I'm not going to touch them right here. This one, which is the semiconductor ETF. So there we go. Its pattern formation is very, very similar to what the NASDAQ is doing. So essentially the same. And then here, let's take a look at the stock of NVIDIA as well while we are at it. Here we go. SOXX has the same pattern as NVIDIA, or vice versa. So on a weekly basis, NVIDIA was actually able to close this gap right here, which is really good. This point which we spoke about could be possible support level has held thus far. So actually NVIDIA might be in this pattern formation, ABCD to 155. And then if we take a look at this on the daily chart, in daily chart it found support right here, which was this 38.2% retracement of a longer term low. Of course, there is trend line here as well. And then here, 5th of August, 6th of September, it came and tested this. What I did not like is that last Friday it just closed just below the 61.8% retracement, but a very, very small trading range. Maybe it paid a dividend, that might have something to do with it on Thursday. But I would really like strength come in this one, and it moves beyond 120. That will be really, really good. And then we can have these 155 as the target. Now let's take a look at IBB, which is the biotech. Here we go. So the biotech, you can see that it's just been struggling quite a bit, but since October of last year, it's just trying to make a some sort of a move to the upside, but struggling a little bit. And it might have done ABCD, so it's got a little bit higher to go. But I think if it gets into this one, this is gonna be this region resistance for pretty strong resistance for the biotechs. Last, we'll just take a look at TNX, which is a 10-year treasury note, which we actually had taken a look on last Friday as well. So just to reiterate that, I look at this one is basically a pattern where we could say it's an inverse head and shoulder, but one of the things is that we could see possible good support coming around the 330 mark, and just below that we have around 290, currently about around 3% is the 200 week moving average. So between where it is now and 3% is where probably this market might find a pretty good support, and that's just the kind of inverse of what we are looking at on the 10-year treasury futures chart that we cover on Friday. So with that, I hope you'll find this video of educational value, and if you do, then please give it a thumbs up, and if you like our technical analysis, then please subscribe to the channel, and if you do, then hit that bell icon button. That way you will know when the new videos are posted. So apologies for our long video, but we covered a lot of things, especially on the sectors. We covered many of them, and we can now see quite a lot of things clearly. how the rotation is actually moving through a lot of this, and then with the subsectors, with the ETFs that we took a look at, such as the home builders. So I think it'll be of educational value to you guys. So with that, thank you very much for watching the video. Good luck, good trading, and I will be back next week with more videos, and then I'll speak to you guys soon.